My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer America. People make friends. I'm just trying to make you a little money. My job is not just to entertain, but to explain what's going on. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. How do you wind up with a day where the market's recent leaders lose their mojo and money managers rotate back to some of the old leaders like big tech? You can't tell the story from the average. Dow dipping 7 points, S&P inching down 0.05%, NASDAQ gaining 0.18%. But daily today, the big buyers can't help themselves, and they leave huge footprints. They have to reach for Microsoft. They have to have Meta. They need Google. Why? Look, you know, I've been getting more worried about the bond market. I've been saying that ever since the Fed cut rates last month, right? Bond prices have plunged. Bond yields, meaning longer-term interest rates, have soared. Not supposed to happen. But when it does happen, money managers reach for the companies that simply aren't impacted by the change in the 10-year, the 20-year, or the 30-year U.S. Treasuries. Rates don't matter all that much to Microsoft or Meta or Google. Neither they nor their clients need to borrow large sums of money, so the bond market's irrelevant to them. I love the lump in Apple and Nvidia, but they were up real big yesterday, so they don't have what Microsoft had today. They don't have the mojo. Does this move make any sense whatsoever? Okay, look, I'd say it's pretty much intellectually bankrupt, but who cares? Sometimes Wall Street's like Chinatown, as in, forget it, Jake, this is Wall Street. Meaning, don't bother to figure it out. It is what it is. But you come to me to figure out, how does this happen? How can people abandon the market's recent winners so quickly, dropping them like hot French fries right into our lap? Simple. See, this morning we got a series of earnings reports that just didn't add up. They didn't fit the thesis. They were disappointing. They don't jive with a rather benign moment when we have the Fed cutting rates, yet employment remains strong. When we get these problematic quarters, several in one day, I might add, money managers default back to the tried and true growth stories that we all know and love. Yes, titans of tech. You know what? These managers can't help themselves. They feel they have to rotate out of what was hot at one point and into something else that's not that impacted by the big rate cut cycle. Here's what I want to do. I want to start with the alleged earnings disappointment. I only use the word alleged because these are really good companies, and I don't want to slam them. Number one is GE Aerospace, long a favorite of mine. Today we learned that there was some weakness in some orders and some lingering supply chain issues when it came to building aircraft engines. Now, it wouldn't be a big deal, except the stock was already up 90% for the year as of last night's close. So people sold first and then asked questions later. They don't think, hey, wait a second, GE has years of demand ahead and aerospace is a great secular growth market. No, that takes wisdom, genuine wisdom. And who the heck has time for wisdom when you can just bring the register? And that's how a fantastic stock like GE Aerospace closes down 9% and no more than that. Then we go to Pulte Group. Yeah, the big home builder reported what looked like a Jim Dandy quarter. But when you look underneath, you see newfound rot, incentives. That was the point. Pulte has to now offer incentives for people to buy homes. The conference call bummed people out because CFO Bob O'Shaughnessy said, and I'm going to quote here, "We expect incentives to remain elevated for at least the remainder of the year," end quote. Huh? What incentives? Aren't the home builders reeling in the money? We don't need no stinking incentives. But then again, loan rates just keep running higher, and that means mortgage rates are moving up. With mortgage rates expensive again, something has to give, and it might be the price of a house, and that's how Pulte plunged more than 7% today. Okay, how about America's best steel company, Nucor? Now, this is supposed to be a huge winner for the Fed cutting rates, but as you'll learn later in the show, steel pricing is horrible right now. So Nucor gave a dismal forecast for the current quarter. Frankly, it kind of took people by surprise. When you do something that causes big estimate cuts, money managers don't try to look past that. They don't know about how Nucor will have a big year in 2025. The Fed keeps cutting, but you got to cut now. They say, get me into something that makes the numbers, and then we'll forget about Nucor. And that's what happens. And that's how the stock of Nucor goes down 6.5%. Now, we all love the autos. GM had a good number, by the way. But what about the auto parts plays? Shouldn't they be good? Don't we like genuine parts? We should, but not when it whiffs horribly. A gigantic miss. You look at the thing, you think, we have so many old cars on the road, you need to fix them. With genuine parts, it seems like a can't miss story. Then you listen to the conference call of Genuine Parts, and CEO Will Stengel tells us Genuine's getting slammed by conditions in Europe and their industrial business. Well, most people didn't even know there is an industrial business in Europe, and an American story. So, once again, get me out of that one pronto, and that's how Genuine Parts' stock gets pummeled for a 21% loss. How about safety? Can't we huddle in safety, right? Isn't that what you're supposed to do when things are uncertain? The action in Kimberly-Clark is apparently not. The maker of Kleenex, as well as all sorts of diapers, had some one-off problems that hurt the quarter. So the seller's body slammed the darn thing. If you own it, you wish you were wearing Depends, which, by the way, are the quintessential Amazon products, because who wants to buy adult diapers at CVS, let alone Walgreens? I think Kimberly-Clark's problems really are one-off. The buyers will come back, but not today. Not today, Satan. That's why the stock closes down 4.5%. So what happens? The disillusioned souls who trade these stocks, and they have been winners. Remember, these people do not own. They rent stocks, and they move their money to stocks that they feel safe and comfortable. That's why Microsoft started going up right at the opening bell. Here's a company with an amazing balance sheet, selling indispensable products to 100 million people around the world, people who pay on time regardless of how the economy's doing. No need for Depends there. You go to Meta, which also has an amazing balance sheet and extraordinary demand for its products. Their AI Ray-Bans are a huge hit, but that's barely a drop in the ocean because they can make so much money from the targeted advertising business, and they will. Or how about Amazon, which is closing in on its all-time high, again, just over 10 points from here, even as it last quarter was hated. Suddenly, though, Amazon's love for its consistency, long-term consistency, I guess. They like Google for the same reason they like Amazon and Meta, targeted ads, referenced again and again as a place to advertise pretty much anything. Now, I know I left out Apple, NVIDIA, and Tesla, but for good reason. See, today we got some negative news about iPhone sales. Not enough to make me want to sell, but enough to ding the stock. And that wasn't just analyst reports. You also got a number from Verizon that didn't jive with the thesis that Apple iPhones selling well. NVIDIA didn't get much love either, but CEO Jensen Huang is headed to India for a fireside chat at an AI conference. Hey, maybe he'll announce a giant sovereign state contract, something he's been hinting at. I would own, not trade Apple and NVIDIA. Tesla, it's a car company, so it's genuinely sensitive to the bond market. No, thank you. They actually have an interest rate concern now that we don't think about them as a robot company. So, yes, the money does flow back to tech titans when the 10-year treasury goes down in price and up in yield. On days like today, big money managers, they get scared of cyclicals and nervous about aerospace, frightened of home builders, supervised by auto parts, and chilled by Kleenex sales. What matters, though, is that we've seen this movie before. It's been happening for more than a decade. Don't worry, the money can rotate just as soon right back to where it was, but you got to wait a couple of days, or maybe even just a day. That's how crazy things are. But the bottom line, big tech made a big comeback today because of the bond market, not anything to do with the stocks themselves. So keep in mind that the pause in the rally is temporary, even as you should still own some of the Mag 7 for diversification. They used to be high flyers, but now they've become lovey blanket stocks. Money managers can't live without their lovey blanket stocks when there is genuine economic risk involved in other kinds of stocks that they didn't expect or didn't think that would happen. You know what? Again, nothing too serious, and I would buy almost every one of the stocks that I mentioned that were down badly today. Let's go to Amy in Pennsylvania. Amy.
Hey, booyah, Jim. How you doing tonight?
I'm doing well. How about you, Amy?
I am awesome. You and your team have an amazing show, and thank you for putting some more jingle jangle into our pockets.
Oh, well, thank you. And the team is amazing. I've been listening to the team. I actually heard them today, which was really quite a change for me. What's going on?
Hey, so McDonald's is one of the first stocks I ever bought. It was a great stock to keep, but considering right around close, it dipped down like $24 a share. So should I ride this out, or should I get the heck rid of it while I'm still ahead?
Amy, this is a great teaching lesson for me and for you. Okay, so McDonald's did have an E. coli link. Apparently, it was with onions, not beef. They did manage to pull everything that was in the quarter. Everything that is connected with this has been pulled. 10 states only. Do I want to advocate buying a stock down 21 without more knowledge? I will tell you this. I think McDonald's is a great company. I think McDonald's is about to report next week. I think McDonald's is going to have a terrific quarter. If somebody downgrades the stock tomorrow on this, then I would indeed pull the trigger. Stephen in Florida. Stephen.
Jim, big hurricane hit Florida. Booyah to you.
Man, I hope everybody's okay, booyah. These hurricanes are really scary. How can I help?
Well, the question's actually from my kids, Alex and Addison. I've always told them that they need to buy what they know, and, of course, now they're holding Disney in their portfolios. It's actually the only non-tech stock they have, and it's been a dud. But it looks like it's on the bottom. Is it going to find some footing? Or
I totally agree with you. Jeff Marks and I went over Disney this morning when we did our morning call at 10:20 for the exclusive for the CNBC Investing Club people. We felt very inclined, as you did. We think it's bottom. Actually, even traced out the chart. I said it is time to buy Disney. Don't forget, they got the big ships coming online, and you know what? They got to It's so much better than a $96 stock. It's ridiculous. All right, you have to keep in mind that the pause in the big tech rally is temporary. I still think you got to own some of the Mag 7. They've become lovely blanket stocks. How crazy is that? You get diversified with them. On Mad Money tonight, Logitech is falling after it's raising its full-year guidance. I have to tell you, I was puzzled about this. I'm going to be digging into the decline with the CEO, hearing more about its place in the computer hardware space, and don't forget gaming. And how could rates and future Fed cuts affect the material stocks? As I mentioned, Nucor pulled back big today. Let's take a deeper dive at Nucor. It's too good a company to just leave on the periphery. Plus, industrial REIT Prologis crossed the tape last week, reporting softer occupancy and rent. I'm checking with the company's top brass to get a better read on demand of a company that I have liked since 2009, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.